Hi, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for June 22nd of 2025. Certainly, as I'm sitting here right now, Sunday afternoon, working on this particular charts and chat pack, we now know that the U.S. has joined Israel in its campaign against Iran, bombing 3 nuclear sites. One of the things that we're looking for is the response from Iran on this. And we see here in this chart from Bloomberg, it's the tanker traffic in the Strait of Hormuz. You can see here very clearly that it doesn't appear to be greatly impacted by the Israeli campaign part of this, but now it'll be interesting to see if, now that the U.S. is involved, Iran's options are few and far between, and we do know that 20% of global oil and LNG exports pass through this strait, and we've got a lot of these flows that are destined for Asia, particularly China, India, Japan, South Korea. And with Europe is now increasingly reliant since they cut their Russian imports. So, and you can see here that there are ebbs and flows, and it is fairly seasonal in nature. You tend to get your shoulder seasons, and during the summer you tend to have increased activity. Well, it'd be interesting to see what's going to happen this coming week. The dollar's been weak, probably gains a little bit of strength here. Obviously, geopolitical tensions, which historically have been rather, I hate to use this word transitory, but they generally don't have long-lasting impacts. Now, what we've already seen in the price of crude, futures prices have gone up in response to this, which is very predictable and it happens a lot. But usually these types of geopolitical issues, as long as they don't manifest into something that's a lot more regional and persistent in nature, tend to be short-lived events in the market. So we may see a little volatility next week, just kind of getting everybody ready for that. Again, the Iranian response will be interesting. They could, go after U.S. proxies in the Middle East, which would be, installations at Qatar and some of the other locations, which again pit Shia against Sunni states. And I don't know that Iran is. I think they're smart enough to know that getting an intra Middle Eastern war with their neighbors, in addition to Israelis and the U.S., is probably not something that they can handle right now. But anyway, suffice it to say that there are things that we are watching very, very closely here in the coming week. It's a chart on global trade. This is from 2021, not meant to be displayed for its current relevance, but I think the relevance here is just the fact that it just highlights how unique and diverse our trading system is. And so I put this up there to kind of memorialize the fact that in just really a couple weeks, we're going to get the end of this 3-month moratorium, if you will, on the tariffs that were announced in early April. And I think as we get closer to that, the market's going to begin to really speculate what the next steps are. I certainly think if this Middle Eastern issue is persistent that we just talked about on the last chart, I think the administration would be very well advised to continue to put these tariff increases out on the horizon a little bit longer. Now, one thing that has crossed my mind here, really in the last couple of days is, if that happens and the idea is, all right, we're going to, on July 9th, which is that 90-day, the end of that 90-day period, if the outcome is, hey, we're just going to keep 10% tariffs on people, except for China, which is 30%, but we keep that in place for a year. Well, that adds a lot of certainty that doesn't exist right now. And uncertainty is really the name of the game. And again, that last chart with bombing of Iran, it just adds to the net uncertainty that's out there. And so this chart, really just highlights how diverse trading networks are, and how difficult it is to really impose like this complicated tariff regime that the Trump administration's been talking about. On this chart, we have really the impact of tariffs to the degree that they are longer lasting. And again, what we've been talking about here right now, what's in place right now, for the most part, are 10%. With obviously some exceptions, and been announcements for steel and some other things that kind of went outside that. But if you tend to have more impactful permanent shocks, the longer that uncertainty blanket stays out there. And so this would certainly argue for coming back with some type of moratorium, extension for like 12 months, which would give plenty of time for some of these trade pacts to be done, which frankly, trade pacts in general take almost that long just to negotiate, let alone paper up and begin to implement. Pivot here to investments, something I've shown in the past. I mean, this is a very linear line. I mean, and this is not even cyclical in nature. It's very secular. I mean, this is we're now like close to 17.5%, 18% of the U.S. stock market being foreign owned, and that's pretty powerful considering that U.S. households own or have a much greater share of equities as a percent of their net worth than they ever did. At a point in time where I think we have roughly, even going back to this point I'll call it right here, where we have maybe half the number of equities that listed stocks that we had back in this time frame now. Very interesting dynamic. Stock valuations relative to the rest of the world. We've talked about this a lot, and if you look at these lines, and it looks a little bit like a rainbow, but again, this blue line represents the trend, and each of these lines on either side represent standard deviations around that. And so what this means, and the fact that we're punching through 2 standard deviations, one means this circumstance where the U.S. is at a distinct value premium to the rest of the world is very, very rare. It's statistically speaking, it would be like 3% of the time, based on the fact that this is 2 standard deviations away from the mean. So very, very unlikely case, but you can see that that's been playing out and kind of getting larger over time. So very rare instance, which itself would argue for having more international stocks, because there is a value disparity. You just have to be patient for that value to be realized, and the catalyst to realize that value to be activated. Recession risk that during the tariffs we know went up. It has since come down in terms of Goldman Sachs. It's still kind of stuck around 40% if you look at the Bloomberg consensus, but by all accounts, again, last evening's events notwithstanding, that you would expect that to probably drop a little bit, somewhat, and obviously if it stays higher, then that would imply that that there are other things afoot, like decreased consumer spending. We'll talk about that a little bit later. Here we have inflation expectations, several different readings of this. The University of Michigan consumer sentiment number, which, by the way, is very much influenced by inflation expectations. And you got the Conference Board and New York Fed, which are, this one's fairly objective, and this one is far less sensitive to inflation expectations. But in terms of its, the indexes that these support. But suffice it to say, consumers out of the Michigan survey, expected a lot of inflation boost from tariffs 1 year out. Again, this is 1 year, and this is longer term. So if you look over here, that seems to be coming down in all of these cases, where bond market is in the gray line, and that's what the implied rate is by virtue of the bond market. And it's telling you that inflation's about 3%. And so all of these are coalescing to that. Now, you get over here to long-term inflation expectations, and oddly enough, you got consumers that are still sky high on this. But if you look at the bond market and what it's telling you, it's like 2.25. So it's expecting that inflation is going to kind of even itself out over time, and that will be okay. Here we have China exports, which in the red to the U.S. we know that that's been negative for some time, some number of months now in particular. China exports to the rest of the world, however, are still positive, even though they are coming down. Now we have the dollar, trade-weighted dollar here in the red. You can see that that's been coming down. If we took this time series back from last November through, maybe mid-year, you see that would come down a little bit further. So we had a lot of appreciation in the dollar, and then then that got unwound, and maybe we've got a little fish hook uptick here coming. And generally, when you have very troubling geopolitical times, that the dollar does catch a bid, so this may go back up. But the interesting dynamic on this chart from Goldman Sachs is that this is plotted against this blue line, which is the growth gap, the U.S. growth relative to the rest of the world. And right now, at least particularly from April, the U.S. is growing its economy at a faster clip than the rest of the world, which if you take this time series back a longer way, there's a lot more correlation here. But that's not in evidence right now. These numbers are diverging, and have diverged quite a bit. And so very interested to see where this goes from here. What do consumers worry about? And why this is important is consumers and consumption itself represents over 2/3 of the economy, and so not too surprising, you've got rising prices, inflation. This is all tariff fears, tariff policies right here, and what's going to happen with inflation. Neither of these would have garnered much interest certainly a year ago, and so that's this is really what's driving a lot of sentiment in the soft data right now, because people just don't know. And then you get down here and you get you get politics, you get immigration, which I think is a real economic variable if you're going to go try to detain immigrant workers that are essential in certain industries of our economy, and healthcare, and you get on down the list here that you can see, and there's obviously a litany of things that people tend to worry about, but only a small handful here that are really, really impactful to them. We've got population, and these are working age individuals, and we do know that the supply of labor has been a little challenging. Even with a growing population, that the labor participation rate has actually come back in a little bit, and you can see that essentially we had the first wave led by the U.S. of total population of working age people, and we get a second wave that's not as big and where it crests here and in the coming years, and you see the U.S. that population's in continuous decline. You can see over time that in the absence of third wave, which would be basically some of the areas of the world that have astoundingly high birth rates right now, like say call it Africa, Middle East, and so on and so forth. But it's a demographic challenge that we're all going to have to kind of deal with. Is the supply of labor, whether that's going to be meeting the demand for labor. Okay, personal luxury goods. Again, another consumer-oriented data point here. You can see This is actually McKinsey, so this is a consultancy that's putting this together. So whereas in the 2024-25 time frame, you're seeing flat to negative growth in luxury in China, and then of course 23-24 that was entirely negative. The outlook is for in all of these areas kind of like modest growth, not outsized growth, but modest growth. Are they being too optimistic? No, I don't know. Luxury goods, can be imported. They could be fabricated locally. They command certainly a higher a premium price and a premium, multiple and all of that. So here we have this general upslope, and this gives me a little bit more confidence to the degree that McKinsey is right about all this, that you're going to have continued growth. You're not necessarily going to have to take a step back in overall activity, and it's really driven by most of the world, maybe except for China perhaps. Now we've got central bank key rates. You can see here that a lot of central banks are starting to reduce rates. This is putting pressure on the Fed, obviously getting President Trump very agitated at his central bank chair. And they haven't followed suit yet because they really are watching the tea leaves, because tariffs could provide a short-term headwind on that. Over here, we've got market expectations for central bank rates, and really the only place where rates are expected to actually go up are in Japan. The expectation is we're going to get 2 rate cuts here in the U.S. That's in that black line. I think that's what the Fed in their last meeting indicated through their dot plot survey. So the Fed's looking for 2 rate cuts. I don't think that they come maybe even in the next meeting, depending on what happens, data-wise, et cetera. But again, market's pricing in a couple of rate cuts. You can see where the rest of the world is going, except for Japan, and that will certainly be influential on where U.S. rates go. Alternative sources of income is something that we look at, and this is here for no other newsworthy item than to say that there are a lot of areas in the market where you can get yield to benefit the portfolio, and not just rely on a straight bond index or something very static like that, because oftentimes those you wind up getting a lot of things that you don't necessarily want, and this represents a nice cross section. You see real estate here a few times: Asia Pacific, Europe real estate, U.S. real estate, global real estate investment trusts. There's just a lot of different ways to get it these days. Now we'll get into some Bloomberg charts. We've got continuing claims in the blue line. You can see that has picked up, but on a historical basis, it's actually very low. So at this juncture, does not overly concern me. And you've got permanent job losses; those have already also picked up. But usually you see these major upticks when you're in a recession, which are these red bands. And I don't think we're at the point where that is relevant yet. Here we have manufacturing and trade inventory to sales, and so looking here for some signs perhaps of people getting out in front of tariffs and stocking up on inventory, because I do think we hit a little bit of an air pocket next month. So we have the tariffs, and then we have the retaliatory tariffs, and particularly with China, one of our biggest trading partners, you had a lot of activity just basically drop to the floor, and that's all going to hit in the July data that we're going to get. You think about time lags for things, and then think about when data gets compiled. And so really July is going to be very telling on whether retailers and other folks had enough inventory to kind of weather this storm. And where do we go from here? Obviously, it will have a distinct bearing. All right, so here we've got business leader surveys. Again, soft data on capital spending. You can see that that continues to come down, maybe accelerated a little bit here in the last few months. And just means that you've got, this is a diffusion index, so you have a net negative or a net number of folks that say that they're going to be reducing capital spending or their outlook is weak, at least. Okay, here we've got retail food and service sales. That is down around 3.3. It is positive, and maybe it looks like we're trying to form a little trend here, but it can't be certain of that. But basically, looking at 3.3%. Now we'll talk about private debt, private equity. This is global private capital, and so you've got a lot of different sleeves of this. Real estate, which we've already talked about, direct lending, infrastructure, secondaries, buying basically, other PE interests, private equity interests on the secondary market, so on and so forth. But you can see that this trend here, again, data going back to first quarter 21, you can see that that trend has been down. So there's a lot of dry powder on the sidelines waiting to be deployed. It's not being put in. Some of the issue happens to be with exits, which we'll look at in the next slide here, and then general cautiousness picks up where that left off. Now we'll look at exits, which is the other side of the coin. Obviously, a lot of dry powder to raise funds, even though we're not doing as many raises right now. I think people are cautious. We saw that in the last slide. This is where people are trying to get out, and you can see here that again, going the first quarter of 2021, where we are now is a fraction of that, and so you can see deal counts coming down. Again, this is all uncertainty, and the market kind of drying up, not going away, but just drying up. So you're not going to zero. You're just you're continuing to move down in terms of your overall deal counts. Now we're back to talking about oil and the crude exports out of the Persian Gulf. As I mentioned, 20% of global oil and liquid natural gas shipments. You can see here, apt to change, but we've been fairly stable, but we'll look for any meaningful downtick there. Now, the probability of Iran closing the Strait of Hormuz is now about 77. So this is basically, as of this morning, about 8 o'clock in the morning. This is from Jim Bianco, and you can see last night, and then the announcement of the campaign here, and we can see that basically the probability went up tremendously with the knowledge and with the revelation that U.S. has actually entered the fray here. And something else that really interests me is, kind of challenging the conventional wisdom of things. And so, a lot has been made over immigration, not going to go there from a political standpoint, but it's interesting to see what the data would say. And I came across this article in G0, which talked about essentially net deportations during various administrations. And oddly enough, the winner is not President Trump, certainly not in Trump 1, although he did increase deportations there. But it's actually President Obama. So I think it really pays when you hear rhetoric and before you internalize it and make it your own opinion, that it's good to do a little bit of research. Last slide here is military spending. This is, been the kind of a burr under the saddle of the U.S. Trying to get some of these countries to pay, quote unquote, their bigger share, which again, their economies are much smaller than the U.S.'s. But you got Ukraine, who's clearly not going to be spending per se. They'll be getting a lot of loans, which will eventually be forgivable, et cetera. But clearly, just in relative terms, you can look at the vast largeness of the U.S. market, particularly in military spending here relative to the rest of the world. Well, that's all we have this week. Obviously, we'll be watching developments very closely over the next several days. And if things get, particularly interesting, it may accelerate the timeline in which I do another market minutes. But again, I'll just wait and see and monitor the data, and we'll be in touch soon. Have a great start to your week. Take care.